Hi, I'm Bob Keiser, Vice President with Global Markets Intelligence at S&P Capital IQ. Thanks for previewing this week's Lookout Report. Global Markets Intelligence believes that these are very complicated times at the Federal Reserve. Fed Chairman Bernanke has started providing preliminary forward guidance on how and when the FOMC might begin to wind down their third installment of unconventional monetary stimulus. This will largely be dependent on sustained downward pressure on the U.S. unemployment rate. The Fed's discussion of a timetable for tapering QE3 has already pushed 30-year mortgage interest rates higher by over 100 basis points in the 2 months leading up to the July 4th holiday weekend. And rising mortgage interest rates appears to be having a moderating influence on the U.S. housing market. For instance, the Mortgage Bankers Association's application to purchase index has lost momentum in recent weeks, for the moment surrendering all of the improvement recorded since mid-March. GMI Research believes that the Fed should proceed with tapering at a sufficiently measured pace that permits the U.S. economy to find a new pro-growth equilibrium capable of generating healthier GDP growth than what we've become accustomed to over the past 4 years. At this point in the economic cycle, there remains some risk that income tax hikes, sequestration, and rising interest rates could result in slower than anticipated economic activity. We believe that the outlook for improving corporate revenue and profit growth continues to be dependent on sustained recovery in housing as a facilitator of more robust GDP growth. For more on our thoughts on the relationship between QE3, the housing recovery, and corporate earnings growth, see this week's Lookout Report titled, "These Are Complicated Times Indeed at the Federal Reserve, Part 2. Thanks again. Until next time, I'm Bob Keiser.